Kamboji, Jaswinder ji, Deepak Mittal ji, and many more other names, which I am unable to name, and I apologize for that. I welcome my past team members as well as CA Mohit Gupta ji, my Vice President, past, and my past President has shown his inability today to attend because he is somewhere else. Before I formally name new team members and before I start today's webinar formally, I invite everyone to join me in a moment of silence, please. Let's take this time to connect with our inner selves and send out thoughts of peace and harmony for all the humanity. Be silent, please. Om Shanti. Pushkalji, I think so. You have started the recording, and I request you also to temporarily mute all participants so the proceedings can run smoothly. Thank you, Pushkalji.
दीपक जी अनम्यूट कर लो।
Thank you, sir. Now, as it is the first webinar in the new year, firstly, I may formally introduce you all with the members of new DTBA team 2025. And firstly, the Reverend President, our President, Sir C.I.S. Khurana ji, Vice President C.A. Sanjeev Bhandari ji, Secretary myself, Joint Secretary C.A. Dikshit Kapoor ji, and our Executive Member Advocate Jasleen ji, C.S. Shivali Gupta ji, C.S. Nikhil Kallara ji. And I may introduce study circle team with the convener C.A. Rajesh Jain ji, co-convener C.A. Pushkal Soni ji, other members being C.A. Anshul Suji and C.A. Shilpa Soni ji. Dear friends, I would like to inform everyone that today's webinar is being chaired by President C.A.I.S. Khurana ji and Coordinator C.A. J. Jain ji and C.A. Pushkal Soni ji will take care of all the technical aspects. Now, friends, I feel delighted to name the distinguished speaker for the today's webinar, Advocate Karanjot Singh Khurana ji. He is partner at Lakshmi Kumaran and Siddhiran Attorneys, New Delhi, who is with us to deliberate on the topic of the day, Union Budget 2025. I must add that worthy speaker, sir, is son of our learned president, sir, Khurana ji. Welcome, Karanjot ji. It sounds like a great opportunity to gain valuable insights from you. And I request you to shed some light on the possible aspects of new direct tax code also, if it is so possible. And I hope this webinar would be an everlasting experience for all of us. करण जी, मैं काइंडली आपसे पूछना चाहूंगा क्वेरी सेशन आप कैसा रखना चाहेंगे एज एंड व्हेन इट कम्स और एट द लास्ट सर?
Sir, I'm more than happy to keep the session as interactive as possible. So I think the members can freely unmute themselves and ask questions as and when they have it.
Great, sir. The query session will be taken by our convener, Sir Sri J. Jain ji, as and when it arises. And members may post their queries as said by speaker, sir, in the chat box or by raising their hands. Now, I request our convener, Sir C. J. Jain ji, to have welcome address to the speaker and to all the present. Arjay ji, please.
Thank you, C. Deepak Jain ji. Good afternoon, friends. At the outset, I would like to congratulate CA Inderjeet Singh Khurana ji on being unanimously elected as the president of our esteemed organization. I would also like to congratulate CA Sanjeev Bhandari ji, Vice President, CA Deepak Jain ji, Secretary, and other office bearers of Team DTBA on being elected to serve this profession under the able guidance of our President, CA I.S. Khurana ji. I would like to express my sincere thanks and gratitude to Team DTBA for giving me this opportunity to serve as convener of Study Circle. I, along with the other members of Study Circle group, CA Pushkal Soni ji, CA Shilpa Soni ji, CA Anshul Sood ji, and CA Kartikeya Jain, will be completely dedicated throughout the year to meet the expectation of the members from this association to impart knowledge by organizing various seminars, webinars, workshops, and study circle group meetings. Today's seminar is on budget. Honorable Finance Minister Srimati Nirmala Sitharaman has presented the Finance Bill 2025 on the 1st February 2025. Like every year, a lot of changes have been made to the Income Tax Act, and provisions relating to individual taxation and rationalization of TDS provisions have been made. Today's webinar will be taken up by our son of our own worthy President Sri Inderjit Singh Khurana ji, Advocate Karanjot Singh Khurana, who is partner in Lakshmi Kumaran and Sridharan, New Delhi. I welcome you, sir.
Thank you. Thank you, sir.
And I welcome all the participants to this webinar and hope that by the end of this session, all the members will be able to gain complete insights into the budget proposals. May I request C. Deepak Jain ji to carry on with the proceedings further.
Thank you, Rijay. Thank you. Now I request my executive member CS Shivali Gupta ji for formal introduction of the speaker. Shivali ji, please.
Thank you, sir. It is my pleasure to introduce our esteemed speaker, Advocate Karanjot Singh ji. Karanjot Singh ji is a seasoned expert in direct tax practice with over 7 years of experience at Lakshmi Kumaran and Sridharan. His expertise spans domestic tax, international tax, transfer pricing, with a diverse client portfolio across sectors such as banking, oil and gas, IT, telecommunications, and more. Karanjot ji has a strong track record in due diligence, complex matters involving permanent establishment exposure, and litigation before various courts, tribunals, and appellate forums. Karanjot ji has addressed many seminars and conferences on direct taxation. He is also a published author with articles featured in reputed national and international journals. We, Team DTBA, welcome you, sir. Now I hand over the mic to Deepak, sir.
Shivali ji, thank you. Now, without any further delay, I hand over the proceedings dice to our speaker, sir, Karanjot ji, for the deliberation.
Thank you.
Karanjot ji, please.
Thank you. Respected members and my dear friends, I think it's been about 10 years when I left Ludhiana and I came here in Delhi to practice income tax here. I think unfortunately for me, I never got an opportunity to address the audience back at home. And I must say that getting into this position, addressing courts is easier than addressing your own father. So, but I will make my best possible attempt to encapsulate and explain the amendments that have been proposed by the budget 25. Though I think the budget started off with the Honorable Finance Minister explaining that the major chunk of amendments will be made by the direct tax bill, which will be introduced sometimes next week. I think even with that being said, there is still quite a lot in the budget, which gives us a sense as to where the direct tax is moving and how the landscape will be featuring in the years to come. As Deepak sir requested, I just wanted to touch upon what we know about the new income tax bill, which will be tabled before the Lok Sabha next week, and what all was stated by the finance minister as far as this bill is concerned. So one, we are not talking about any amendments to the Income Tax Act 1961. This is going to be a new direct tax code, which has been dubbed for a very long period of time. So if we go back into the history, there was an attempt to bring in a new direct tax code back in 2010. It could not fructify. And then even after this government came in 2014, an attempt was made by Shri Arun Jaitley, the then finance minister, to bring in the new code. However, Income Tax Act has been a very dynamic law in terms of the judicial precedents. And I must say that there is no country which produces as many judicial precedents in income tax as India does. That is something that is not only felt, but as a matter of pure statistics, that is very well known also internationally. So therefore, with a law that is that judicially well known, it is very risky to bring in a new code, because there may be a sense that you may undo all the judicial precedents that exist and everything may have to be reworked. I think it is this very fear which has led us to carry on the act which was enacted in 61, even today, with the changing dynamics of the business landscape, and make an attempt to sort of align this law with the business needs. I believe there is some disturbance. I'm sorry. Okay. So it has been this very landscape that has allowed us to carry forward the legacy of 61 Act and try and align it with the businesses that are existing even today. So this has been done by making slew of amendments every year, and that has led to Act becoming as complex as it is today. In so much so that even certain professionals, at least like me, find it so difficult to keep a track of all that is happening in terms of circulars, notification, case laws, etc. Even for the local industry, it was felt that it is difficult to implement the law and to ensure compliances. And even for the outside investors, it was felt that the Income Tax Act is acting as a deterrent to encourage investment into the India. So I think the government finally took the bold move of making an attempt to scrap the existing law and bring in a new direct tax code. Now, what is known is that the new code is expected to be implemented from assessment year 27-28. So we will still have one full year, not only to implement the proposed amendments to the Income Tax Act 1961, but more importantly, to give our inputs to the new direct tax code. So what is stated by the Honorable Finance Minister is that the new bill is intended to be very clear and direct in the text. What is known to us at least is that the language will be made simpler. The provisions which have already lived their life and whose sunset has already lapsed, those provisions will be omitted, removed from the existing Income Tax Act. And then act which is approximately half in terms of both chapters and words will be tabled in the parliament and then brought into effect. Now, what is supposed to happen is, just like we saw certain Q&A after the budget this year, there may be separate Q&As which will be issued for each topics and chapters to the direct tax code. So that will be like a key which will serve as a guidance factor for both the taxpayers and the taxmen, and ultimately for the judiciary to interpret the law. So there may be a change in the dynamics as to how we interpret the act altogether. And lastly, the government is also looking at a number of measures to bring in tax certainty and to reduce tax litigation with the new bill. I'll be touching upon some of these because the amendments that have been proposed by the finance bill, they give some hint of where all of this is headed. With that being said, I think I'll just move on to the amendments that have been proposed by the budget 2025. And I'll just discuss some of the key issues that require or warrant the attention of the professionals and the industry at large. So I'll be touching upon the presumptive schemes, the TP changes, the changes in relation to the amalgamations, updated return of income, TDS, TCS, charitable institutes. And then at the end of it, we'll also discuss some of the changes that are made to personal income tax as well. Starting off with the presumptive scheme, which has been brought for the electronic manufacturing in India. Now, if you look at it, it seems to be a very industry specific provision. But what I can tell, at least with our experience of dealing with the government, is that this scheme is something that is going to pave the way for the future bill as well. I think the government feels that gone is the time where you ensure a pinpointed accuracy with the tax collection, but there can be other alternative ways with which you at least collect tax with some sense of approximation rather than with a sense of pinpoint accuracy. Presumptive scheme domestically has always ensured that. In fact, so many professionals already continue to enjoy the benefit of 44 ADA, wherein they don't prepare their books and they estimate their income of 50% and end up paying taxes on that. That is one of the reasons that after the implementation of the scheme, so many tax returns for professionals do not go under compulsory scrutiny. So I think one of the suggestions that the government has accepted from the industry is to have presumptive schemes for industry specific scenarios, and then you collect taxes based on these schemes. So for the taxpayers who are ready to pay taxes based on the presumptive scheme, there may be the litigation may be very low. But for people who want to declare lower incomes, they may still have to get their books of account audited, etc., and then pay the adequate taxes based on the actual calculations. So it's like an alternative scheme that the government may be bringing for various sectors. Now, with that being said, we know that the presumptive schemes are generally very easy to implement. But in this case, I just wanted to highlight certain practical difficulties that may come with the present form of the presumptive scheme. Now, the way this scheme is supposed to be brought is a new section is supposed to be inserted to allow non-residents who are engaged in the business of providing services or technology in India for the purpose of setting up electronic manufacturing or in connection with manufacturing or producing of electronic goods to a resident company who is establishing a facility under a scheme which is notified by MeitY, the Ministry of Information Technology. Now, actually, if you look at it, this is very close to what Apple is doing in India. So Apple is now in the process of setting up their electronic manufacturing facility in India. And Apple has a number of suppliers who are helping Apple to set up their electronic manufacturing facility that is being currently handled by Foxconn. So what will happen is during this time when the suppliers are providing services to the facility being set up in India, there may be a lot of on and offshore services which will be provided by the vendors. Now, due to the presence of employees for the onshore services in India, it could also result in constituting a permanent establishment. And as we know, the computation of profits that are attributable to the permanent establishment is a fairly complex mechanism in its own count. Even the CBDT admits it in its own circular that there is no certainty as to how this exercise has to be carried out. And we have seen that officers have come up with numbers ranging from 5% to as high as 80%, which the CBDT states in its own circular. So with keeping that into account, what has this scheme has done is 25% of the amounts that are received by the non-resident are deemed to be the income in relation to these services. And considering, say, these services are provided by a non-resident, you effectively pay tax at the rate of 35% on the 25% presumptive income. Therefore, essentially, the effective tax rate works out to about 9.5%, so which is less than 10%. This is at par with the rates that are provided in the tax treaties, most of the tax treaties for fee for technical services and royalty. So you may end up paying a tax of less than 10% for both offshore and onshore services. So irrespective of whether you have a permanent establishment or not, you can get into this scheme and pay tax at the rate of about 10%. The only flip side is that the non-residents do not get the benefit of any carry forward of or set off of brought forward losses or unabsorbed depreciations. Now, this is all simple. What is the complication with these schemes? Well, the point is the moment these schemes are brought in, I think what the government should have done is to also look into the overlapping provisions within the existing framework of income tax and found a way to address those particular provisions. Now, presently, in its present form, we have Section 115A in Income Tax Act, which provides a gross rate of taxation of 20% for fee for technical services and royalty. This rate is applicable if you do not have a permanent establishment in India in terms of the treaty. Separately, there is 44DA, which is applicable if there is a permanent establishment in India. Now, as far as these two provisions are concerned, they are kept mutually exclusive in as much as if you have a PE, 44DA applies, 115A doesn't apply, and vice versa. 44BBD, when it was brought in, no pain has been taken to prevent overlap with both 115A and 44DA. So therefore, the problem that will come up now is, say, for example, there is a non-resident who is providing offshore services for electronic manufacturing in India. Now, in which case, 115A will provide a flat rate of 20% without any deductions, whereas 44BBD will have an effective tax rate of 10%. Now, which is more specific over the other is something that is a matter of debate and will have to be settled separately unless a specific clarification is issued. Juxtaposed to this, say if a non-resident has a permanent establishment in India. Now there, which provision is more specific? If you look at 44BBD, it is specific for services to electronic manufacturing in India. Vis-a-vis, if you look at 44DA, it is specific to fee for technical services and royalty. So therefore, in either case, offshore or onshore, in the absence of any specific clarification and in the presence of this overlap, I think there may be some clarification that the government may have to issue. The other point that may come up is, I think it is very well known that 44BBD is not going to create a charge of tax where there is none. So in other words, if the income of the non-resident is not taxable on account of treaty benefit, etc., then in which case the income will not become taxable only because 44BBD provides a presumptive rate. But one aspect that the people may have to look into is, as far as the domestic law is concerned, 44BBD is worded to sort of suggest as if it creates a tax on the entire sums received. Now, say, for example, if there is one common contract wherein there are alienable services, some of which are not taxable and some of which are taxable, I think it can create certain confusion. Lastly, the provision does not provide as to what is the exact scope and the meaning of the term services and technology which is provided by non-resident. Say, for example, whether a software provided is a service or not in the context of what is envisaged in the scheme. Say, for example, someone simply providing back office support services, whether that is supposed to be covered or not. What is that nexus that is there with the electronics manufacturing in India is something that leaves a little bit of room of interpretation. Again, some sense of clarity on this could be very well appreciated. Now, moving on to the aspect of arm's length price for the block period. Generally, as we know, that the arm's length price and the computation thereof is an annual exercise. So in other words, in terms of Section 92 CA, the AO has the power to refer the computation of arm's length price to the transfer pricing officer or TPO. And then the TPO will compute the assessment for one particular year. And then whatever are the findings of TPO are binding on AO based on which the total income will be computed. That's the present scheme. Now, in many cases, because transfer pricing is a very industry-specific and a assessee-specific exercise, it is seen that the computation of 1 year can apply across a number of years. And in fact, in many jurisdictions, there is already a prevalent practice of devising a particular kind of transfer pricing strategy for an industry for a particular year, and then that is extrapolated into a number of other years. Now, India is sort of accepting that as well. And India is saying that we will apply concept of transfer pricing for a block of 3 years. So therefore, an assessee is to exercise an option once the TP order is passed and subject to the DRP findings. Once the assessee exercises the option, what the 92C amendment envisages is that the TPO will look into the comparables and the comparability of the transactions of 2 subsequent years. And then the TPO will import the prices computed for the first year into the second and third year. And therefore, the price that is computed in the first year subject to DRP findings will apply across the 3-year period. This essentially is being done to provide a sense of certainty to the taxpayer and to ensure that the price computation of 1 year, the benefit of that can be taken. Needless to say, this is an option-based exercise, and the assessee will exercise this option only if they're ultimately satisfied with the TPO computation in the first year. This is not a compulsion on the assessee. On touching on this aspect itself, the government is also planning to expand the safe harbor rules. That is to say, the safe harbor transactions, their scope is supposed to be enlarged. The government has already committed to bring in safe harbor for non-residents who are providing component storage facilities to the electronic manufacturers in India. They've also committed to bring in safe harbor for more taxpayers. Now, certain points to ponder on this particular aspect is the ALP, that is, or the arm's length price, which is determined in the first year, will that simply be extrapolated into the second or third year, or only the methodology will be extrapolated? So to give an example, say in the year 1, net margin method at 17%. Now, will the AO take 17% into second or third year? Or will the AO simply say that, okay, I'm going to apply transaction net margin method for second and third year? Or will the AO say that transaction net margin method, same set of filters, but different comparables, or same comparables, but different arm's length margin? I think these are aspects which are yet to be granulated, because the final scheme is yet to be notified. Separately, it is also not yet known as to whether the option will have to be exercised across different transactions, or it is going to be exercised for all the transactions that has been scrutinized by the TPO in the first year. What level of scrutiny TPO is required to do in the second and third year? Is it like an overview just to see the comparability of the transactions? Or is it going to be a detailed TP study for second and third year, in which case the scheme may not be that lucrative? I think these are aspects we'll have to wait for, because the government has already committed that within 3 months, they will come up with a detailed scheme for determining the block period, for determining the block assessment in TP cases. I think this one I'll quickly touch upon. In income tax, there is a concept of significant economic presence, which expands the scope of business connection, as we know.
May I take a leave?
Please, sir.
This should have been the less important for the professionals here in Ludhiana. You may please take upon the next topic.
Okay. I'll just touch upon the business reorganization. So in the present form, in section 72A, if there is any amalgamation, there is a fresh lease of life which is given to the losses of the amalgamating company. So say if A is amalgamating into B, and A is owning an industrial undertaking which has losses in its books, say for example, where the period for carry forward of losses is only 2 years, then the moment A is amalgamated into B, B gets a fresh lease of life for the losses, and the losses are again carried forward for another period of 8 years. If we look at the legislative history, this scheme was brought in by 1967, Finance Act 1967. And back then, the carry forward of losses was allowed to the amalgamated entity to encourage amalgamation of loss-making units. What was felt was that India was trying to develop the manufacturing capabilities in the country. And it was felt that by doing so, India will be able to revive some of their manufacturing units. And therefore, there may be a sense of encouragement with the units that are otherwise doing well to acquire sick units and carry forward their losses for another period of 8 years. So there seems to be a policy change as far as this provision is concerned. What is now provided is that the losses will be carried forward only for the balance period. So in my example, if the erstwhile entity had already taken, say, 6 years for the carry forward worth of losses, then the losses will be carried forward only for remaining period of 2 years. This clearly, as I said, is a policy change when we compare to how the losses were allowed in 67. Now, one thing that is not known and which is not very clear is how will these provisions transition into the existing carry forward of losses? What the fine print of the finance bill says is that these provisions will apply to reorganizations that are taking effect on or after 1st April 2025. So therefore, for all amalgamations that are effective 1st April 25, the new provisions will come into force and they will only be allowed carry forward for the balance period. For amalgamations that are undertaken prior to 1st April 25, the losses can be carried forward for 8 years. Now, say for example, someone has already filed a scheme with NCLT and the scheme is still pending approval of NCLT. Say the NCLT approval comes after 1st April 25. But the appointed date of amalgamation is before 1st April 25, say it is 31st March 25. Whether in which case new provisions will apply or the benefit of grandfathering under the old provisions will be given. That is not yet clear. I would want to argue that once the scheme is already filed before NCLT, the old provisions should apply, but that is a subject matter of dispute that has to be undertaken separately. Next one is updated return of income. Just 1 second. Next one is updated return of income. So the concept of updated return of income was brought in to allow taxpayers to revise their return of income even after the period of revision is otherwise over in terms of section 139. Now, just to recapitulate, and as we all know, normally the return of incomes are to be filed during the assessment year and they can be revised up to 31st December. Now, till 31st December, the revision can happen at the option of taxpayer and the returns can be revised n number of times. And the judge-made law under Dharmendra Textile is that once there is the revision of return of income, then the revised return will replace the original return and will be assumed as if the revised return was the return of income filed. So therefore, if any subsequent assessments, etc. are to happen, it will only happen on the revised return of income and not on the original return. That is clear. However, any return which is filed generally after the period of expiry of revised return, those returns are generally declared to be void. Updated return was the concept was to allow taxpayers to overcome this hurdle and to revise their returns to make upward declarations of income in cases where the taxpayers wanted to come clean and disclose certain omissions, etc. So in the present form, the provision allows updating the return of income within 24 months from the end of the relevant assessment year. So say, for example, for assessment year 23-24, the return of income can be updated by 31st March 26. However, this comes at an additional cost. So in order to update the return of income within 12 months, the taxpayer has to pay an additional tax of 25%. And if it has to be updated between 12 to 24, the additional tax is 50%. Additional tax here means tax plus interest that is applicable for delayed payment of taxes. The government, the Honorable Finance Minister stated in a budget speech that the concept of updated return has been a resounding success and that a lot of taxpayers have come clean and they have updated their return of income. So she felt that it is good to extend the period of limitation for updating the return of income from 24 months to 48 months. And what has been stated is that by paying additional tax of 60% if you're updating between 24 to 36 and 70% if you're updating between 36 to 48 months, you can update your return of income. It must also be remembered that the updation cannot happen if an assessment or reassessment is already pending against you. And that is where I think the next amendment is very crucial. What is stated is that if a notice under section 148A, which we know is the pre-show cause notice to 148, if a notice under section 148A is issued to you after 36 months from the end of relevant assessment year, then you cannot update your return of income. I repeat, if a notice under section 148A has been issued to you after the end of the relevant assessment year, after 36 months, then in which case you cannot update your return of income. However, if at the stage of 148A, the proceedings are dropped, you can update your return of income. What logically flows from this is that the concept of assessment, reassessment pending, the government is not including 148A within its ambit. Therefore, if you receive a notice of 148A within 36 months, it is jolly well your right to go ahead and update your return of income and simply respond to 148A by saying that I've updated the return of income, paid the additional tax, and the matter be put to rest there and then. According to me, this amendment in that sense is crucial because it clarifies that 148A is reassessment, and in that sense is still amenable to updation of your return of income. Yeah. I think I've also see a question, can ITR be updated to disclose foreign income or foreign bank account?
एफडी वगैरह जीरो है,
Yes.
बैलेंस हैगा 146
So if you look at the fine print, I think what the law at least says is that you can update your return of income only to increase your total income. Therefore, strictly read the provision. Actually, you may not be able to update only to make disclosures of foreign bank accounts, etc. If that is only to update the schedule. Needless to say that if you intend to make a disclosure of these incomes, obviously you can update your return of income.
सर अगर हमने फॉरेन इनकम डिस्क्लोज करनी हो अपडेट करके,
I think, Pushkal, what I remember from the provision is, if there is already a notice pending against you, then I think it is not allowed, to my recollection. Otherwise, if there is no notice pending or there is no proceeding pending under any law, then you can update your return of income, even for foreign incomes. I can check and get back, but that's what my memory serves me.
ओके सर, थैंक यू।
No problem. So there has been some rationalization to TDS, TCS provisions also. Yeah. There has been some rationalization to TDS, TCS provisions also. One, I think the good news is 206 AB and 206 CCB, which were the provisions in relation to the higher rate of taxes where there were non-filers of your ITR. Those provisions have now been removed. So basically, all the checks, etc., that the industry had to put in to go into the compliance portal and see who is a non-filer, etc., all those are now done away with. And what really remains is 206 AA, which is higher rate where there is no PAN. So therefore, the problems of no PAN still remain. The problems of non-linking of PAN and Aadhaar still remain. However, 206 AB and 206 CCB, where there were non-filers of return of income, that is completely omitted from 1st April 25. Second, there have been some threshold revisions to thresholds, etc., which I'll just show. But amongst these, I think the interesting ones are 206C1H is also omitted from 1st April 25. So as we know that 206C1H was TCS of 0.1% on sale of goods. Now, there was seemingly an overlap between 194Q on purchase of goods and 206C1H. 194Q obviously had a sense of precedence over 206C1H, but it really always left sellers wondering as to whether they should collect tax or not, or should they really wait for the deductor to deduct taxes. It was also seen in many cases that the sellers would not collect tax, assuming the deductor would deduct, but then the later wouldn't, and then there was a sense of non-compliance. Looking all those complexities, the government has accepted the representation to completely do away with the provision of 206C1H. Second, the thresholds for TCS on LRS under section 206C1G, those have been enhanced from 7 lakh to 10 lakh. Third, the delay in deposit of TCS has been decriminalized in as much as if the TCS is deposited before the filing of TCS statement, then the provisions in relation to prosecution should not apply to TCS in those cases. I'll share the slide deck with the members separately. There has been some increase in the thresholds. I'll just, for the sake of time, I'll not go through these individually. I think the interesting one is 194I, where the threshold for rent has been increased from 2,40,000 to 50,000 per month. This is important to remember because the Honorable Finance Minister in a speech said 6 lakh. It is actually not 6 lakh, but 50,000 per month, because if the rent exceeds 50,000 in any of the month, then you have to deduct tax in each of the rent considerations. Then there has been an increase in FTS also. The amount has gone up from 30,000 to 50,000. This is, I think, applicable for all professionals as well. Moving on to the amendments relating to the charitable institutes. So the first one is something that is very interesting. In case of charitable institutes, if there are certain transactions with certain specified persons which are not at arm's length price, then there is a breach of the provision, and in fact, it can also result in cancellation of registration. I'm sorry, before I proceed, I think there is one question. It's been said that if rent is say 25,000 per month, will TDS be applicable from third month? No, sir. So the TDS under 194I under the amended provision is applicable only if rent is 50,000 or more in any of the month. So it's not 50,000 is not the annual limit, it's monthly limit. Yeah. So in case of charitable institutes, in case there are transactions with certain specified persons as mentioned under section 13, then those transactions need to be at arm's length price. If the transactions are not at arm's length price, that can even result in cancellation of registration. So it's a out and out breach of the overall scheme of charitable institutes that is given for exemption. Now, what is stated in the specified person is a donor and also relatives of donor and a concern in which a donor has a substantial interest. What is supposed to be amended in the scheme is that the threshold is supposed to be increased from 1 lakh in a given year or 10 lakh till totality. So in any year, if the total exceeds 10 lakh, then the donor becomes a related party. That's not the big case here. Interestingly, what they say is relative of the donor and a concern in which the donor has substantial interest, they will no longer be a specified person. Now, this, according to me, will give a whole lot of tax planning to the charitable institutes, because it's otherwise a very well-known mechanism that donors will give money to the charitable institute and then use their related parties to take the money out in other forms. So now, earlier at least, they had to ensure that the transactions were at least perceived to be at arm's length price. With this amendment, even that aspect is no longer required. So the concern in which the donor has a substantial interest and the relative of the donor no longer are a specified person for these charitable institutes. There are just a couple of other amendments also. So one, I think in the present form, if there was a provisional registration that could have been cancelled if there was an incorrect application or an incomplete application for registration, it is clarified that incomplete applications shall no longer be a ground for cancellation of registration. And lastly, I think currently the existing period of registration is 5 years and you have to reapply for registration after 5. Now, what is proposed is that the period should be increased to 10 years for certain smaller charitable institutes, where they say that the total income of the trust without exemption is less than 5 crores in 2 years prior to the financial year in which the registration is sought to be applied. This comes from 24-25. Yeah, I think before I proceed, there are a couple of questions. I'll just take those as well. Okay, and will amount paid under CSR? Amarji sir, I think not very clear with the question.
ਕੰਬੋਜ ਸਾਹਿਬ ਕੁਐਸਚਨ ਕਲੀਅਰ ਕਰ ਦਿਓ ਪਲੀਜ਼, ਕਲੀਅਰ ਨਹੀਂ ਹੈ ਮੈਨੂੰ ਵੀ। ਕੰਬੋਜ ਸਾਹਿਬ ਦਾ ਮਿਊਟ ਕਰ ਅਨਮਿਊਟ ਕਰ ਦਿਓ।
Kamboj sir, are you listening? Sir, we may take this a little later.
In fact, the only half-written question was, am I audible? My voice is
Yes,
clear?
sir.
Yes, sir.
Yes, yes,
Yeah. Please clarify, will the amount paid under CSR contribution will be treated as a contribution to cover the persons required to be disclosed, the relatives, etc.?
Sir, so it will be like this. Generally, CSR contributions are made to a CSR trust are structured to be in the form of donations only. Now, therefore, as far as CSR contributions are concerned, if they are made by a company, then any related party of this company, as per the proposed amendment, will not be a specified person. So to answer your question, in the existing provision, say a company A has given a CSR donation, all related parties of company A could be seen as a specified person under section 13. After the proposed amendment, they'll not be specified persons.
Okay. But if the amount is more than a 1 lakh and for the total more than 10 lakh rupees, what will be the position then?
But the donor will be specified person, but a concern in which the donor has a substantial interest will not be a specified person. So in my example, A, which has made that donation of 1 lakh and 10 lakh, that will continue to be a specified person. But say a subsidiary of A, B, that will not be a specified person because they specifically removed that. So the inclusion of a relative and a concern in which the donor has substantial interest, that aspect has been removed
That has been removed.
from the definition.
Okay, okay. Check, correct. Thank you.
Thank you. Yeah, I think startups I'll just quickly touch upon. The benefit that was existingly available to the eligible startups was that they were to be incorporated between 16 and 25. Now that sunset date has been extended to 2030. Just one point that I wanted to touch upon, if any members have startups they're advising on, generally it is felt that transfer pricing provisions are not applicable if the startup is not availing the benefit of 80 IAC during the 10-year period. Just to recapitulate, under 80 IAC, startups can get a tax holiday for 3 years out of any 10-year period. Now, if the startup is otherwise registered under 80 IAC but not taking the benefit during that 7-year period, it is generally felt TP is not applicable. Recently, a Bombay High Court has held otherwise, and they've said that during the entire period, transfer pricing provisions or specified domestic transactions will be applicable. Yeah. I think with that, I just wanted to move on the certain provisions that are applicable to the individuals. So,
Sir, excuse me, one query
Yes.
left of some member, CM Niji.
Yes.
If a property is on rent for 4 months only, with a monthly rental of rupees 65,000 per month, then TDS will be applicable?
Yes, sir. In fact, this is the precise point I was making, that the Honorable Finance Minister said the threshold is 6 lakh. It is not 6 lakh. It is 50,000 per month. So if in any
Exactly.
month the rent exceeds 50,000, TDS is applicable.
Exactly.
So I think these slab rates are very well known. I think this seems to be the highlight of the budget this year. In fact, the Honorable Finance Minister saved the best for the last. So this is very well known. The only part is that she's clarified as well, and 87A rebate for incomes up to 12 lakh, etc. Those are not applicable in case you are earning certain incomes that are taxed at special rates. So say capital gains, winning from online gaming, etc. All those will be subject to tax as per the specific provision. For incomes that are taxable at normal rates, there the benefit of slab rate may or the benefit of rebate under 87A may still be there. Coming on to the amendments in relation to income from house property. Now, in the existing present form, I think most of the members are already aware, but just for my benefit, Section 22 creates a charge of tax on annual lettable value of house property. Annual lettable value is defined to mean the value at which the house property is normally can be normally let, or the actual rent received. Therefore, under Section 22 read with 23, there is a tax on the notional value of the house property. Now, further, if the house property is self-occupied, or in cases where the house could not be occupied on account of employment or business profession elsewhere, the annual lettable value of two properties is deemed to be nil. That's the present position. So therefore, what really flows from this is that in case the house is not self-occupied, but the owner of the house is staying within the same city where this house is, then technically speaking, you could not treat the annual lettable value of the house to be nil. Right? I repeat, in case, say I'm staying in Delhi, but I'm not occupying my own house, I cannot treat the annual lettable value of that house to be nil because I'm staying within the very same city. However, if I'm staying in Bombay and I say that I'm staying in Bombay because of my business or profession, and that is the reason I'm not able to occupy my house in Delhi,
then I can treat my house in Delhi, the annual lettable value of that to be nil. Therefore, in cases where the people were not self-occupying the house in the existing provision, there was an extra added requirement to positively demonstrate that you were not able to occupy the house on account of your business or profession. Practically, this was never really implemented, but the scheme really contained, the fine print really contained this extra obligation. Now, I think looking at the practical application of the provision, this extra requirement has been done away with. And what is stated is that if such house is self-occupied or could not be occupied for any reason whatsoever, the annual lettable value of 2 houses will be deemed to be nil. This really is going to provide a lot of impetus into the real estate market, and people who want to buy properties within their own city for various reasons, even for investment, etc., they can now declare the value of these houses to be nil. There is some interesting amendment for salary also. I'll just take 2-3 minutes on this one because there is some technical aspect here. Though I think the provision, the amendment is seemingly very straightforward, but there is some nitty-gritty that may warrant some discussion with the members. Now, today, there is no tax on perquisites if the income under the head salaries is up to 50,000. What I mean by this is, if we look at section 17(2)(3, it contains a clause within that generally any benefits provided by an employer to the employee will not be taxable in the hands of the employee if the salary of employee is less than 50,000. Then there are some other specific clauses in section 17(2) to include certain perquisites within its ambit. For example, rent-free accommodation. For example, employee stock option. So there are various clauses which make certain specific inclusion to perquisites. And then there are 2 generic inclusions, one being 17(2)(3 and another being 17(2)(8). 17(2)(3 says if there is any employee whose salary is up to 50,000, then any perquisites that are other than those which are specifically mentioned will not be included in the salary. 17(2)(8 says that if there are certain perquisites which are provided in Rule 3, those will still be included in salary. Now, what happened in 2001, interestingly, is that when this limit of 50,000 was provided, in Rule 3, a residuary clause was added to say that if there is any benefit which is provided by an employer to the employee, the benefit or the arm's length value of that benefit will be deemed to be a salary of the employee. So therefore, what happened is 17(2)(3 provided exemption. 17(2)(8 said what is specified in Rule 3 is still a perquisite. Rule 3 said everything is a perquisite other than which is not provided. Therefore, 17(2)(3, the way it stands today, is a dead letter, because the moment you exclude from this, you'll come to 17(2)(8 and whatever is excluded will still again get added by Rule 3. Now, government has not taken note of the amendment to the Rule 3 in 2001. And what they have done is they propose to increase the limit of 50,000 in 17(2)(3 without fully appreciating that the way these thresholds stand in 17(2)(3 is a dead letter today. So what the government is saying is that we had fixed this limit of 50,000 way back in 2001. They need to be increased. We will increase it over a period of time, and they've given the power to CBDT to increase the limit. What really needs to happen is, even in Rule 3, CBDT needs to make an amendment to ensure that people who are given benefit in 17(2)(3 are again not taxed in terms of Rule 3. So that's a representation I think that we have also filed before the government, and let's hope that when they issue the necessary notifications for 17(2)(3, they also make necessary amendments to Rule 3 as well. This amendment is proposed to apply from 1st April 26, so necessarily the notifications will come thereafter. I think lastly, I just wanted to touch upon this Vatsalya scheme. What is proposed is that in order to encourage investments into NPS by parents for their wards, government is saying that contributions can be made by the parents, and the contributions made by the parents up to 50,000, deduction for that will be allowed. I must quickly hasten to add, this deduction is allowed only under the old regime and not in the new regime, because this deduction is available under section 80 CCD subsection 1B. 80CCD2, just to be on the same page, is an exception to the new regime. Benefit of 80CCD2 is available in the new regime. 80CCD1B benefit is only available under the old regime. So though government has brought in the benefit of Vatsalya scheme, this will be available only for those opting for the old regime. The other fine prints of this are that 25% contributions are allowed to be withdrawn in accordance with the scheme, tax-free. And if the amounts are received on closure of the scheme on account of the death of minor, etc., then the amounts are not taxable. This amendment comes into effect from assessment year 26-27 only. I think that's all I wanted to cover. I'm more than happy to have any questions that are there at this stage.
There are some questions on the screen as well.
Okay, I'll just have a look at them. Yeah, I think the slab rates that are available in 115 BAC, there are no separate slab rates for senior citizens or super senior. I think it's one rate for everyone. Next is if total income is 12.5 including special rate, income of 75,000, then rebate will be available or not. Okay, so the rebate is available only if income is up to 12 lakh. If the total income including special income is exceeding 12 lakh, the rebate may not be there. However, marginal relief would still be available.
एक सर इससे ऊपर वाली क्वेरी है, रेंट इज 47,500 for 8 months.
Then still no TDS.
But in the last 4 months it is 52,500 per month, sir. Then it will be applicable.
Yes, then it will be applicable. So if in any month the rent has exceeded 50,000, the TDS will be applicable. Yes. So it's not about, just to clear, I think someone is looking at average rent. It is not about average rent the way it is worded. It is about if the rent exceeds 50,000 in any month or part of month. That's how it is worded. Marginal relief may not be needed in rebate cases. Rebate cases will be, just to be on the same page, rebate cases will be those where the income is less than 12 lakh or less than 12 lakh. Marginal relief will be cases where income marginally exceeds 12 lakh. In the example that we took, their income was 12.5 lakh. Therefore, the marginal relief was available and not rebate.
स्क्रीन शेयरिंग बंद कर दोगे?
हाँ, yes.
Thank you.
हाँ जी सर, एनी मेंबर, राजेश जी कोई और क्वेरी किसी मेंबर की चेक कर लें।
ट्रांसफर टू राजेश जी।
तो चैट बॉक्स से तो कोई
जैन
और
साहब।
नहीं है।
जी सर,
चैट बॉक्स से तो कोई ऐसी चीज नहीं है।
उन्होंने हैंड रेज किया हुआ है।
सर हैंड रेज है कोई?
हाँ, कंबोज सर का हैंड रेज।
हाँ जी, कंबोज
With
सर।
respect to
सर आपकी वॉइस नहीं आ रही।
हाँ जी,
अब आ रही है।
hello,
हाँ जी कमल साहब।
हाँ जी।
Mr. Karanjot, my query is with respect to your slide on income from house property regarding 2 properties or more.
Right,
Hello.
sir. Right, sir. Right. I'm able to hear you, sir. Please go on.
In the last of that slide, you are mentioned relief to the multiple owner of properties at the place of their residence. Please
Right, sir.
clarify that. What is that line?
Sir, see, in the existing form, under section 23, what you have to do is that annual lettable value of 2 houses is deemed to be nil if it is self-occupied, or in case where these are not self-occupied, you're not able to occupy them because you're residing elsewhere due to your business, profession, or your employment. Therefore, if you're residing within the same city and you have houses, multiple houses within that city, you cannot take benefit of the exemption unless it is self-occupied. So say, for example, there is a house, say, for example, a farmhouse within your own place where you're otherwise residing, say in Ludhiana. You cannot take benefit of this saying that unless you say it is self-occupied. Okay, you're not staying in the farmhouse because you're otherwise staying in Ludhiana only. You can't say that because of my profession I have to put up somewhere else, and therefore I'm going to treat it as annual lettable value as nil. Now, with the proposed amendment, what they say is you don't need to give any reason. Whether it is self-occupied or not self-occupied will deem the value to be nil. Therefore, naturally, the intended beneficiary of these are people who intend to own houses within the place of their general place of residence. That's the context, sir.
But otherwise, I have seen there is very, very less application of this provision while filing the return. I don't think anybody, majority are not disclosing the annual value of the other properties in case it is not rented out.
I fully concur with you, sir. That's exactly what I said, that practically, if you see it, no one was really thinking about this clause. And what government is doing is actually aligning with the practical practice also.
But of course, if a person is having income more than 50 lakhs, with the disclosure of the assets and liabilities, only then that can be covered.
No, you're right. Absolutely
And
right.
that too in case of scrutiny.
Correct.
Not otherwise.
Right. You're absolutely right, sir.
Thank you.
हाँ जी सर, अरजय जी जनरल क्वेरी के लिए सर मेंबर्स को ओपन कर देते हैं। जनरल क्वेरी आपस में कोई भी डिस्कशन है, जनरल क्वेरी है इनकम टैक्स पे 10 मिनट
सर एक क्वेरी है, ट्रस्ट विद देयर रजिस्ट्रेशन ड्यू फॉर रिन्यूअल इन सितंबर 25. इट्स अ क्वेरी रिगार्डिंग registration of trust. Can I go through? Karanjot ji?
Sir, I've seen the query.
Okay.
Now, what is stated is that if the renewal is coming up in September 25, will this trust have to apply for automatic renewal, or will there be systematic, or will their application have to be separately filed, or will it be automatically renewed? What I understand is, sir, if these are trusts who are getting the benefit of the amendment, that is those smaller trusts that I mentioned, whose receipts do not exceed 5 crores without the benefit of this exemption, there automatically the exemption will apply to you. You need not make fresh applications. However, if you're not falling within that and your income is more than that, then obviously you need to file the form and get the new registration again.
I think it's 5 crore.
5 crore for the last 2 years, sir.
Okay.
Pardon, please, sir. What you are saying?
When is applicable?
When this new provision applicable? 1st April 25, sir.
Hey, Karanji, I want to clarify what you have said. I apologize for not being able to note you.
So I'll repeat,
yes.
Sir. The amendment is that there are some smaller trusts whose turnover in the last 2 years does not exceed 5 crore. There, the period of registration is proposed to be increased from 5 years to 10 years. Now, let us say the question is, their period of 5 years is coming to an end on September 25. What I'm saying is, as on 1st April 25, the new law will come into force. So as on September 25, if they are falling into those small trust condition, then in which case the period is automatically 10 years for them. They need not go for registration again.
Okay. But there is a slight confusion in the proviso where it is read as provided that where an application is made under subclasses 1 to 5. Where an application is made under subclasses 5 and 1 to 5 and the total income without giving and so वो conditions आ गई, तो ये conditions at the time of filing of application नहीं पूरी होनी चाहिए सर?
Sir,
to give effect to this proviso,
where the condition is applicable as per the this thing. So therefore, if the application is made under those clauses and you satisfy this condition, then you need not go for registration again for 10 years. That's the premise, right?
My point is that, sir, the conditions which are to be fulfilled for the previous year, in which such application is made.
2 years, right? It says.
Yes, in which the application is made, sir. It is subject to the year in which the application is made.
I'm with you, sir. So what I'm saying is, therefore, for all the trusts who satisfy these conditions as on September 25, then they need not go for these registrations again. When I say September 25, that is to say, whatever is stated in the provision, if you satisfy those conditions, then your period is automatically 10 years.
Okay.
Sir, if the renewal is due in the month of March, then it will be automatically renewed?
No, sir. Application has to be
There is
filed.
one raise of hand.
Sir, application has to be filed there.
Application has to be filed. Okay.
Currently, my
ਕਪੂਰ ਸਾਹਿਬ
point is
ਕੁਝ ਕਹਿ ਰਹੇ ਨੇ ਕਪੂਰ ਸਾਹਿਬ ਕਹਿ ਰਹੇ ਨੇ ਕੁਝ ਅਨਮਿਊਟ ਕਰ ਦਿਓ ਕਪੂਰ ਸਾਹਿਬ ਦਾ ਪ੍ਰੇਮ ਕਪੂਰ ਜੀ ਦਾ ਯੈਸ
Hello.
Yes, yes, sir.
ਹਾਂਜੀ ਹਾਂਜੀ
Good evening, everybody. Currently, in the case of a person who has total income less than 12 lakhs, let us say around 11 lakhs, but that income includes an income of rupees 1 lakh taxable at special rates, like let us say transfer of a digital asset. Can that person file a Form 15G for non-deduction of TDS on his income from bank interest, which is more than 1 lakh, which is less than 1 lakh?
Sir, I'm just speaking of my memory here. I think that form is to be filed if your income does not exceed maximum amount which is not chargeable to tax.
Yeah.
Now the thing is, sir, your income is chargeable to tax, but because of rebate, your tax payable is zero.
Very
You have
true.
to remember, sir, the slab rates, even as per the new regime, is 4 lakh only, not 12 lakh.
So that means he cannot file 15G.
That's my understanding. Yes, sir.
Because it also includes in the declaration the words are, and I will not have to pay any tax. The tax payable on my income is nil.
That is a subsequent part of it. But
Yeah.
we also have to look at it. It also says that if my income does not exceed maximum amount which is not chargeable to tax. Technically, your income, the moment it exceeds 4, it is chargeable to tax, but the rebate makes it zero. Tax payable as zero.
Okay. Thank you.
Karanji?
Yes, sir.
Sir, one more issue to deliberate. In this budget, they have come up with some mechanism whereby the penalty orders have not been transferred to the AO rather than to the from the Joint Commissioner. What is the rationale behind these all provisions? Joint Commissioner से उन्होंने AO पे इम्पोज कर दी हैं 271 CA, 271 D, 271 DA कि from the 1st April 2025 the penalty order will be passed by the assessing officer.
Sir, what they I remember this. So basically, sir, what they have felt is initially there are some penalties wherein they have given a designated base rank, right? Saying that these penalties will not pass by an officer below the rank of so and so. What has been felt is that in certain administrative provisions, it is better to even give authority to lower officers, because what is felt is at the higher officers, there is a lot of applications that get a lot of proceedings that get pending and piled up. So they've actually given powers to even AO or the junior officers to frame penalties in these cases.
So there is one query from Jasminder Singh ji. Please elaborate on TDS on payment to partners, which is applicable with effect from 1st April 2025.
Right. So that
It was brought in by Finance Act 2024.
Finance number 2 at 2024. So that provides for a TDS rate of 10%. Now, currently, sir, there is already a lot of pending representation on that. I must say that even in the final bill, there may be a change to it. Now, as of now, what that scheme really contemplates is that any money that is paid by the firm to the partner that has to suffer a TDS rate of 10%. The provision does not create any kind of distinction between sums that are allowable in the hands of firm or sums which are disallowed. So what it really says is that being in the form of salary, remuneration, or any other consideration, etc., the firm has to deduct 10% when it pays any money to the partner, and the tax has to be deducted at the earlier of physical payments out of the firm to the partner, or even credit to the account of the partner. So I think what is left in terms of the clarification is that say, for example, tax is also deducted because the firm will have to, in case in relation to certain salaries, remuneration that are not allowable in the hands of the partnership firm because the sums are more than the limits that are given in 40B5. Technically, even there, the firm will be required to deduct TDS. How the utility will function is not known because the partner will declare only salaries to the extent of what is taxable in his or her own hands and not what is exactly paid by the firm. Therefore, there may be a mismatch between 26 AS and what the partner offers as tax. We filed representations on that, and we are hoping CBDT will bring in some clarifications on these aspects. So,
जसविंदर जी
Jasminder, I'm not
अनम्यूट
able
कर
to
लो
hear you.
जसविंदर जी
Not audible, sir. No, sir.
पुष्कल जी जसविंदर जी
सर वो अनम्यूट हैं बट उनके आई थिंक सिस्टम में कोई इशू है।
ठीक है
सर एक ये विपिन चोपड़ा जी की क्वेरी है
करण जी आई हैव वन क्वेरी।
Yes.
जो 12 लाख की जो थ्रेशोल्ड लिमिट हुई है अभी,
Yes.
if including special rate income exceeds 12 lakh, then in that case 87A rebate is available.
No, sir. No. It is total income, including all special rate incomes.
Okay.
अवनीश सिंह जी हैज रेज्ड हैंड
हाँ
सर
जसविंदर जी आ गए हैं सर।
जी 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 सर विड्रॉल फ्रॉम कैपिटल ਉਹਦੇ ਤੇ ਜਿਹੜਾ ਪਾਰਟਨਰ ਦਾ ਉਹਦੇ ਚ ਕੀ ਸਿਸਟਮ ਬਣੇਗਾ?
Sir, withdrawal from capital, ਤੁਸੀਂ profits ਦਾ ਗੱਲ ਕਰ ਰਹੇ ਹੋ ਜਾਂ talking about general capital withdrawals?
At 31st March 2025 there was a capital balance of 10 lakhs.
Right.
There is no interest may be there is no salary to the partner.
Right.
Interest may be there, ਚਲੋ ਆਪਾਂ ਕ੍ਰੈਡਿਟ ਕੀਤਾ ਉਹਦਾ TDS ਕੱਟ ਲਾਂਗੇ.
Right.
Then remuneration profit sharing is not taxable otherwise in the hands of partner.
Right.
तो ਉਹਦੀ ਕਲੈਰੀਫਿਕੇਸ਼ਨ ਵੈਸੇ ਤਾਂ ਤੁਸੀਂ ਦੱਸ ਹੀ ਦਿੱਤਾ, ਇਹਦੀ ਕਲੈਰੀਫਿਕੇਸ਼ਨ ਆਏਗੀ ਬਟ ਇਹਦੇ ਵਿੱਚ ਕਾਫੀ ਐਂਬੀਗੁਇਟੀ ਹੈ।
ਸਰ ਮੇਰੇ ਹਿਸਾਬ ਨਾਲ ਐਟਲੀਸਟ ਜੋ ਮੇਰਾ ਉਹਦੇ ਤੇ ਕਾਲ ਹੈ ਸਰ, ਆਪਾਂ ਨੂੰ ਨਾ ਉਹਦੇ ਤੇ ਦੈਟ ਜਿਹੜਾ ਕਨਸੈਪਟ ਹੁੰਦਾ ਹੈ ਆਪਣਾ ਐਜੂਸਿਡਮ ਜੈਨਰਿਸ, ਬੇਸਿਕਲੀ ਅਗਰ ਤੁਸੀਂ ਉਹ ਟਰਮਸ ਦੇਖੋਗੇ ਨਾ, ਸੈਲਰੀ, ਰੈਮੂਨਰੇਸ਼ਨ, ਕਮਿਸ਼ਨ, ਬੋਨਸ ਔਰ ਇੰਟਰਸਟ, ਇਹ ਸਾਰੇ ਜਿਹੜੇ ਹੈ these are earnings of a partner from the partnership. These are not actionable claim withdrawals. ਤਾਂ ਆਪਾਂ ਐਜੂਸਿਡਮ ਜੈਨਰਿਸ ਲਗਾ ਕੇ ਐਟਲੀਸਟ ਇਹ ਕਹਿ ਸਕਦੇ ਹਾਂ ਜਿਹੜੇ ਐਕਸ਼ਨੇਬਲ ਕਲੇਮਸ ਹੈ ਯਾਨੀ ਕਿ ਕੈਪੀਟਲ ਵਿਡਰॉल्स ਹੈ, ਦੇ ਸਟੈਂਡ ਔਨ ਅ ਡਿਫਰੈਂਟ ਫੁਟਿੰਗ, ਉਹਦੇ ਤੇ ਐਟਲੀਸਟ TDS ਨਹੀਂ ਹੋਣਾ ਚਾਹੀਦਾ। ਦੈਟਸ ਮਾਈ ਹੰਬਲ ਵਿਊ ਸਰ। I know that there is some confusion on this, but at least my view is capital withdrawals ਜਿਹੜੇ plain actionable claim capital withdrawals ਹੈ from my balance itself of what is already credited, ਉਹਦੇ ਤੋਂ ਨਹੀਂ ਹੋਣਾ ਚਾਹੀਦਾ TDS।
ਜਸਵਿੰਦਰ ਜੀ ਦਾ ਪੁਆਇੰਟ ਇਹ ਹੈ ਕਿ ਜਿਹੜੀ ਵਿਡਰਾਵਲ ਹੈ during the year, this should be reflected against the withdrawal of the capital and interest should be calculated in accordance with the capital withdrawal, and there need not be any withdrawal during the years, and after calculating the entire profits and then at that point of time interest be credited as well as the partners to the salary be calculated, and then whatever the case may be, there may be a drawing or not, then it will be calculated. In that case, we can very safely say that during the year we have just withdrawn we had withdrawn the capital and not any interest or any salary to the partner.
Right. See, in that sense, I understand even from a calculation standpoint. See, obviously money is fungible, right? As long as your withdrawals from the capital do not exceed the capital balance itself that it stored, you can very well say that I withdrew money from the capital balance, number one. So to take an example, say year starting te mera capital balance 100 रुपए है। Now मैं 10 रुपए withdraw ਕੀਤਾ, 20 रुपए ਕੀਤਾ, ਮੇਰੇ capital ਦੇ ਵਿੱਚ amount ਵੀ credit ਹੋ ਰਿਹਾ, interest ਹੋ ਰਹੀ ਹੈ, salary ਹੋ ਰਹੀ ਹੈ। Obviously money is fungible according to me, ਜਿਵੇਂ ਆਪਾਂ 14A ਦੇ ਵਿੱਚ position ਲੈਂਦੇ ਸੀ, it can very well be stated that what I've withdrawn is the capital balance that already stood credited to my account, so within that 100. Now thereafter, the moment it exceeds the capital balance itself, already ਜਿਹੜਾ credit ਹੋ ਰਿਹਾ ਉਹਦੇ ਤੇ ਤਾਂ already TDS ਕੱਟ ਕੇ ਹੀ ਆ ਰਿਹਾ। As I said, the TDS has to be at the earlier of credit or payment, whichever is earlier, right? ਤਾਂ ਜਿਹੜਾ ਆਲਰੇਡੀ ਕ੍ਰੈਡਿਟ ਹੋ ਕੇ ਆ ਰਿਹਾ ਉਹਦੇ ਤੇ ਤਾਂ TDS ਕੱਟਿਆ ਹੋਇਆ, ਜਿਹੜਾ ਫਰੈਸ਼ ਕ੍ਰੈਡਿਟ ਹੈ ਉੱਤੇ ਕੱਟੇ ਜਾਓ। ਅਗਰ ਤੁਸੀਂ ਬਿਨਾਂ ਕ੍ਰੈਡਿਟ ਕੀਤੇ ਪੇਮੈਂਟ ਕੀਤਾ ਉੱਤੇ ਵੈਸੇ TDS ਲੱਗੇਗਾ।
ਦੈਟ ਮੀਨਸ ਕਿ ਜੇ ਤੁਹਾਡਾ ਕੈਪੀਟਲ ਬੈਲੈਂਸ ਹੈਗਾ ਉਹਦੇ ਚੋਂ ਆਪਾਂ ਪੇਮੈਂਟ ਕਰ ਦਈਏ ਤੇ TDS ਨਹੀਂ ਲੱਗੇਗਾ। ਜਦੋਂ ਆਪਾਂ ਸੈਲਰੀ ਇੰਟਰਸਟ ਕ੍ਰੈਡਿਟ ਕਰੀਏ ਤੇ ਉਹਦੇ ਤੇ TDS ਲੱਗ ਜਾਏਗਾ। ਐਂਡ ਫॉर दैट ਮੈਟਰ ਜਿਹੜਾ ਪ੍ਰੋਫਿਟ ਸ਼ੇਅਰਿੰਗ ਤੋਂ ਇਲਾਵਾ ਕੋਈ ਵੀ ਉਹਨੂੰ ਕ੍ਰੈਡਿਟ ਕਰੀਏ ਅਕਾਊਂਟ ਉਹਦੇ ਉੱਤੇ TDS ਲੱਗ ਜਾਏਗਾ।
परफेक्ट सर, परफेक्ट।
थैंक यू।
और जो सर इंटरेस्ट और रेमुनेशन है ये हम प्रॉफिटेबिलिटी फाइनल करके अप्रैल में कर सकते हैं, मंथली करने की कोई जरूरत तो नहीं है?
Sir, there is no compulsion. See, just to be on the same page, no TDS provision will ever tell you कि तुसी credit कदों करना।
जी,
TDS
exactly.
provisions will at any time will say that if you do certain actions, credit or payment, then you have to do it. So just to be on the same page, I have seen thousands of cases where the accounting standards may compel you to create a credit. But if the company is not created credit, we've defended cases to say that there is no obligation of TDS. So the 194T will never tell you when to credit the sums in the capital account. All it will say is when you do, please deduct tax.
Right, right, very much right. Arjay ji, any other queries, sir?
But in case when the partnership deed says that it has to be credited to the partner's capital account or to a separate account on monthly basis, then how can you postpone the TDS provisions?
Okay, so then I breach my partnership. No, I breach my partnership deed. So what? There is no consequence in income tax, right? Like at best, Rajesh ji, at best, someone can say that the partners agreed to something. They did not go by that.
Okay.
Right?
Thank
There
you.
is no adverse implication of that under income tax.
As long as we don't credit monthly, right, sir?
Okay. So there is one query from C. Vipan Chopra ji. I think it relates to the Companies Act, not the
Yes,
budget. Sir, in
yes,
case of
yes.
profit of a company is more than 5 crore in a year, then profit reduces in next year, whether CSR liability will continue for next year also, or CSR liability will remain for 1 year only when the profit is more than 5 crore. Vipanji, this query relates to Companies Act, not the Income Tax Act. Vipanji is there?
Yes, sir. Yes,
Pushkalji,
sir.
check.
Yes, sir. Yes, sir. Yes, sir.
Vipanji, you can raise your query directly.
ਸਰ ਇਹ ਕੁਐਰੀ ਇਹੀ ਹੈ ਜੋ ਲਿਖੀ ਹੈ ਕਿ ਨੈਕਸਟ ਬਟ ਤੁਸੀਂ ਕਹਿ ਰਹੇ ਹੋ ਕੰਪਨੀਜ਼ ਐਕਟ ਨਾਲ ਰਿਲੇਟਡ ਹੈ ਇਹ।
विपिन सर, मैं इनकम टैक्स ना डर डर के बोल रहा था, कंपनीज एक्ट पूछ रहे हो।
चलो विपिन जी, I can answer this query on behalf of Karanjot ji.
जी सर।
The CSR liability is applicable. CSR provisions under section 135 will be triggered only when there is a profit of more than 5 crore in the immediately preceding year.
ठीक है सर, बस 1 साल नहीं लगेगी ना, 1 year only
Sir,
applicable.
1 year, no provision.
Yes,
1 year,
when-
2 year,
when-
leave aside 1 year.
Okay sir, okay.
Only when there are other parameters also, but
Yes,
on
sir.
profitability front, 135 will be triggered only when there is a profit of more than 5 crore in the immediately preceding year.
Clear sir. Clear sir, clear.
Karanjot ji, is
Thank
it
you.
okay with you if I reply on your behalf?
Yes, sir. Yes, sir.
अगर कोई Pushkal Soni is there, he also looks into this CSR activities. Can you add something?
सर बिल्कुल सही कहा है सर, परफेक्ट।
सर अजय जी, आप अथॉरिटी हैं सर, आपके बाद कंपनी एक्ट में हम क्या बोलेगा कोई?
नहीं, ऐसा नहीं है सर, बस is it okay with you, sir?
Thank you sir, thank you. जी सर, जी thank you.
तो अजय जैन जी, मेरे ख्याल में
सर एक
करण जी
और आ रही है क्वेरी।
जी जी जी।
If someone is sending होना चाहिए, someone is sending money abroad for education purposes from his own resources, then TCS will be applicable or not on this remittance?
0.5% applicable है सर उस पे। लोन वाले पे एग्जम्पशन दिया है, if it's from my own pocket then 0.5% is still applicable.
No, as per the new provisions, this TCS provisions on education either from loan or from own resources has been eliminated.
No, loan has been eliminated. Own resources, I think, is still 0.5%.
Yes, sir, I do agree with the speaker. Loan provisions are limited.
Loan pay, they have done that. I think for own money, they have still kept it at 0.5.
So only I think also the loan amount has been
Yes,
eliminated.
loan amount.
Otherwise, only loan amount.
Right.
If savings, it has to be deducted. The amount has been changed from 7 lakhs to 10 lakh rupees.
That is for
Yes.
LRS. That is for LRS. That's
Yes.
completely for
LRS.
LRS.
Education purposes, it is only through LRS scheme.
No,
If you
you're
get money-
right. No, sir, the only point I wanted to mention is, in fact, there is some trick there. So you're right. Education will only go through LRS. Now, the point, the way it will happen is every time the bank will do a purpose-driven exercise. So if the money is going, say, for example, for education, up to 10 lakh, even in any case, there is no TCS, that's clear. The moment it exceeds 10, then it will be 0.5 for education, but in other cases, it will be 20. That's how it is. So it will always be that purpose-driven exercise.
Okay. The authorized dealer have to do this exercise along with the declaration from the person who is remitting the money.
Yes, they verify that through the purpose code and then they ensure their TCS liability. I think there's just one more question, sir. What I saw that 194T is applicable from which assessment year? I think, sir, 194T is not an assessment year based exercise. It's a financial year because TDS provision. It is applicable from 1st April 25.
Exactly.
So
Sir, एक मेरी query थी.
Sir Jitinder Chugh ji is asking for unmuting. Please, Pushkal ji, please.
Audible, sir? I think
Jitinder
I'm
Chugh ji.
Yes.
तो मेरी आवाज आ रही थी?
आ रही है जितेंद्र
आ
जी?
रही चुक साहब।
आज आ रही है आपकी।
मेरी क्वेरी ये थी, जैसे सुपर सीनियर सिटीजन के केस में जो स्लैब रेट इज देयर विल बी नो टैक्स अप टू 5 लाख रुपीस. तो अगर उसकी जो इनकम 12 लाख से ज्यादा है और अगर वो न्यू रिजीम अडॉप्ट करना चाहता है तो उसकी जो टैक्सेबिलिटी है वो 4 लाख से शुरू हो जाएगी और 5 लाख में भी एप्लीकेबल.
Sir, under the new regime, it will be 4 only. Because once you go into that, the slab rates of 1B will apply to you. That's a very good question, but I have never thought of it. But according to me, it will be 4 lakh only because then that provides a specific scheme then.
क्योंकि इस न्यू रिजीम में तो कोई सुपर सीनियर सीनियर सिटीजन वाइज कोई ऐसी बाइफिकेशन तो है नहीं.
Correct. That's a very good question. But I think, sir, वो 4 से शुरू होगा. It's a valid problem, but वो होगा 4 से because I don't think there's any exemption.
एक और चीज मैंने बोलूंगा तो जैसे अभी जैसे 12 लाख की लिमिट थी या लास्ट ईयर 7 लाख की लिमिट थी, पर जो सब जो लेट फीस लगती है जो स्टार्ट फ्रॉम वो 1000 रुपीज और 5000 रुपीज दैट स्टार्ट फॉर 5 लाख रुपीज. तो इस चीज के लिए सर कुछ रिलीफ या कोई अमेंडमेंट का कुछ है प्रपोजल सर?
नहीं सर, I don't think there is anything in the bill on that. Nothing on that.
तो जैसे अभी स्लैब्स तो इंक्रीज कर जा रहे हैं बट सब जो लेट फीस है वो 5 लाख से शुरू होती है.
हाँ, you're right. Then वो 1000 रुपए फिर भी लगते हैं. You're right.
जी सर, थैंक यू सर.
Thank you sir.
और वो तो सर फीस लग रही है आपको कंप्लाइंट रखने के लिए. That you do because anyhow if limit has been increased to 12 lakh you are supposed to file your tax return even then.
तो साल भी बढ़ा दिए सर, 2 के 4 कर दिए.
हाँ, 2 के 4 कर दिए. दीपक जी देखो, मेरे ख्याल I don't think there is any other query.
Khurana ji, we should go towards closer, sir. My president, sir, should we go towards closer, sir?
I think. Thank you.
Thank you, Karanji. Thank you very much.
Karanjot ji.
You're remarkable. Yes, sir. Kindly continue if you wish.
Yes.
Thank you, Karanji.
सर अब नील जी ने
Very good.
एड्रेस किया हुआ है.
Elaborated.
Sir, एक last query सी.
I think there is one more query. Let's first complete that query and then.
Please.
Karanjot ji, थोड़ा जा can you please put some light on property sale by an NRI funds received after deduction of TDS. So those funds when will be remitted outside, TCS will be applicable again on the outward remittance?
Sir, to my understanding, see, there are 2-3 parts to it because this will technically be a FEMA issue. I'll explain it in a bit. See, the thing is, usually I'm not very sure whether the monies are paid under that repatriable or a non-repatriable scheme. There are separate non-repatriable schemes for non-residents. If it is that $1 million that is paid from the NRE account in terms of that, then to my recollection under FEMA, these are not under LRS schemes. There, if it is not under LRS, then obviously 206C1G doesn't apply, because that applies only if it is LRS remittance. LRS applies to sums paid by a person resident in India. So if these are non-residents holding monies in NRE account, because I'm making all those assumptions that you declared to bank, you made it NRE account, these are non-repatriable, you're doing through that because those are the normal modes of doing it, then in which case TCS should not be applicable. Obviously, you'll have to make these disclosures to bank adequately.
Yes, it is it is totally clear. These funds are repatriated from the non-resident by its own sources. Then no TCS is applicable. We are doing it and no TCS is being levied on that.
Okay.
I think it is completed every query.
Thanks a lot.
Thank you, Karanjot, giving the elaborate, covering all the previous and the current changes and giving the input about the new tax code which is coming in the next week. I think we will have sufficient time for the code to discuss. I also thank you all the members who have joined for this webinar with full zeal and interest, because this time everything was open, several things were placed on portal, we received lot of information by the finance minister herself or by the news media coverage on television, on newspaper. Even then, the joining on this webinar is the not the gaining interest of the members to gain more and more knowledge, and also to show solidarity for the association. I am also thankful to the uh, office bearers of the DTBA who made their lot of efforts by convincing the members, making telephone call, making them aware. And at the end, I'm thankful to the Mr. Pushkal Soni and the over convener Shri Rajesh Kumar Jain ji for conducting this webinar in a well organized manner. And thank you, members.
Thank you. Thank you.
Thank you, sir.
Deepak ji.
Deepak ji.
Thank you, sir. I think so. We may now conclude and to close the today's webinar with a positive note that फिर दोबारा जल्दी मिलेंगे कुछ अच्छे के लिए कुछ और knowledgeable के लिए सर. Thank you. Arjay ji.
Thank you, ji. Thank you. Thanks a lot, ji.
Thank you very much,
Thank you
sir.
all the
Thank you.
participants.